Let's talk financials now, specifically the wild moves we've seen in interest rates this month and the impact on some of Wall Street's biggest banks. Joining us now, Marty Mosby, Director of Bank and Equity Strategies at Vining Sparks. Marty, good to see you this morning. Worst performing, or second worst performing sector, I should say, last week, given the big move in interest rates. Does that make sense to you? And to what extent are you expecting downgrades in net interest income forecasts the next time we hear from the bank CEOs, only a month or so after, of course, they reported?
Well, good morning, Wilfred. And yes, what we have is really with the banks, two different discounts that come in and different, kind of weightings. One is the interest rate cycle and the other is credit. Right now, we're dealing with the interest rate cycle and the market's already starting to take out a lot of that value. So what we're looking at is that the stock prices last week reflected a full 5 to 6% discount on top of what we already had. So when you start thinking about earnings coming down, yes, we'll probably see some downgrades in the sense of some net interest margin compression as we're going to more drops in interest rates going forward. But overall, what you'd see is that the value in the stocks already reflects most of those downgrades that we're going to see.
Is it too simple now to say it's better to have exposure to those banks that have a lower proportion of their earnings coming from net interest income, like Goldman Sachs and Morgan Stanley?
Well, that's the easy way to look at it, but really what you want to look at is, what else is going on with these banks. If you look at, Citigroup, for instance, right now their price is below its tangible book value. So the positive for the banks is really the deployment of excess capital. So they can generate somewhere between a 17 and 20% return just on buying back their stock and paying the dividend. So you would look at that other element, which is the positive side of this, and some of these banks have a much more of a punch from that side, which will support their stocks and eventually kind of win over as the calm on the risk fear begins to lessen.
Marty, does the trading environment and the challenges that these banks have had in the trading environment bear on the stocks? Is that part of the issue that they have in reaching an ROE that would be attractive?
Like for Morgan Stanley and Goldman Sachs, that's definitely been a case. We've seen investors cinch up because of the uncertainty with what was going on in the market, especially in the interest rates. And fixed income is really the big mover in a sense of what you want to see in trading to be able to generate the profits. So as we start to see any of this begin to kind of plateau, when we see any direction of interest rates begin to kind of be illuminated a little bit better and clearer, you'll see that those trades will start to come back in, and that will help Morgan Stanley and Goldman Sachs once that happens.
Marty, there's clearly a lot of challenges, as you've outlined already. But what about valuations? And you think about the broad sector as a whole relative to the rest of the S&P 500. Is this a moment where you look at it and think this is a screaming buy, or you think that there's a lot of risks in the discount to the S&P 500 is legitimate?
No, really, a lot of those discounts that we just talked about, interest rates and credit, are already being factored in. So what we're looking at is right now the market reflects 25 basis points of increase in credit costs, and it almost takes away all of the benefit that the banks have had over the last couple of years in riding the interest rates up higher, as if they didn't really restructure their balance sheets. So the banks have restructured. They'll defend against losing all of that net interest margin over the next couple of years. Credit, they've de-risked their balance sheets, so the credit costs won't go up nearly as much as what people imagine right now. But what we really have to fight is the perception. As long as there's a perception that there's a recession on the horizon, interest rates are going lower, then you really can't, look at that as, okay, we got to be all in, because that perception will drive valuation. Eventually, if that perception bursts, the valuation fundamentals will drive these stock prices higher.